Welcome back to Out of the Rough. I'm with Jake Young. Jake Young is a mortgage professional with American Family Funding and a veteran in the mortgage industry. Welcome to the show.
Thank you, Fred.
Jake, I want to speak with you today about a new way to finance mortgage insurance and to deal with the high cost of mortgage insurance, because a lot of people, they're getting FHA loans.
Right.
And FHA is a great product, 3.5% down.
Right.
But the mortgage insurance sometimes can be expensive.
Yes.
And you've helped many clients get into loans that aren't FHA and help reduce the cost.
Yeah. A lot of my business, Fred, is from first-time home buyers. And as I was considering different options besides FHA financing, as you mentioned, it's a great option, but FHA recently has raised some of their fees associated with taking a loan with FHA. And so I was trying to look for different options that didn't have as many fees, if you will. And one of them is to get a conventional loan, and you can buy out the mortgage insurance up front, so there's no mortgage insurance for the life of the loan. You pay a fee up front, and a lot of times you can get that credited from the lender that you're doing the loan with, and they'll pay for that fee. You may have a higher interest rate, but you can actually buy out your mortgage insurance.
So let's talk about that, because you're still getting mortgage insurance, but you're paying it all up front.
That's correct.
And you're paying it up front, and there's two ways to do it. One was from the seller, where the seller pays for it to entice you to get into the house.
Right.
And the other one was the lender using a higher rate, correct?
Right. So as an example, you can take a higher interest rate as opposed, let's say for an example, if the conforming or your normal interest rate is 4.5%. You may take a slightly higher interest rate of 4.8%, and that would be enough money that you could use lender credit by taking the higher interest rate in order to pay off the mortgage insurance premium that they would charge.
Yeah,
yes.
and back in the older days, the conventional lending, you paid a upfront fee and a monthly mortgage insurance fee,
right,
which was only a fee that protected the lender, that if you went in default, the lender didn't lose as much money.
Right.
But it didn't do anything for you other than to allow you to get into that house at less than 20% down.
Right, exactly, exactly.
Yeah.
And this is a tool that you can still, for an example, buy a house 5% down, but not have any monthly mortgage insurance.
So you go 5% down versus 3.5% down, so it requires another 1.5% down. And you have a recent case study on this, right?
Yeah, I recently just took a first-time home buyer that was looking to buy a house, and they came to me and they said, "Hey Jake, we'd like to take out an FHA loan." And I said, "Great, let me review our options and see what works best." And in this scenario, they wanted to buy a home for $305,000, so your typical home in Santa Clarita. They only had 5% to put down. So they could go FHA or they could go conventional. It wasn't until recently in the state of California that mortgage insurance companies would allow 5%. But now they do. Now they do. And so we had that option. And looking at their mortgage, or the cost of mortgage insurance for FHA was about $170 a month. Well, if I got them a slightly higher interest rate, but bought out their mortgage insurance that we were previously talking about, they could save themselves that $170 a month, but have a slightly higher interest rate. And so when I had done all the numbers crunching, it would save them over $160 a month by having a conventional loan, buying out the mortgage insurance, unlike FHA, and so you would have no mortgage insurance. You would just have your typical 30-year fixed loan with no mortgage insurance.
Now, the one thing is you're buying out that mortgage insurance, so you avoid the upfront mortgage insurance with FHA,
right,
and the monthly costs associated with the FHA, but you got to put a little bit more money down.
Yes.
And you have to have a little bit better credit, because FHA is a little more flexible on the credit,
right,
than conventional underwriting.
So you would need your higher FICO or credit scores, and you're right. FHA is if you're a little bit more unstable on the loan side, whether it's your employment or your credit history. It may be easier to get an FHA loan approved as opposed to this conventional loan. But otherwise, this is a very good option for somebody who has great credit, great income, and doesn't want to pay that monthly mortgage insurance, wants to save a little bit every month.
Now, this can be used on a refinance also, correct?
Oh, absolutely.
So if you don't have 20% equity and you want to refinance and your rate is up at 6.5%, you can bump the rate a little bit, finance that mortgage insurance,
Right.
and refinance at a lower rate.
Yeah, and I was just looking at one today where the appraisal came back, and instead of having that traditionally 20%, they were slightly short. They had about 18%, and so I was able to use this lender credit, pay the mortgage insurance up front with the lender credit. They have a slightly higher interest rate, but hey, rates are great right now anyway. So at 4.5%, and they could still refinance and take advantage of the low interest rates.
Right, right. And that's just an example. Of course, your APR will be a little bit higher with closing costs and so forth. But if you want to take advantage of this, call Jake Young. Your email is
jake@affloans.com.
And your direct line number?
755, area code 661, 755-8555.
Jake, thank you very much.
Thanks, Fred.
Great job. Appreciate you having on the show again.
you.
We're going to jump to a quick break, but when we come back, I got the Robert Briner. He's an entrepreneur, but he is an expert when it comes to marketing. We're going to talk about how to get out of the rough with your marketing into success.